So Friday was a bit of a whiplash, at least for me, because we had those jobs numbers come out. The market seemed to know what to do about that. They didn't like it very much. And then the ISM numbers came out, turned right around. What did we take out of this?
Well, first week of the year, and not a great start. Many investors are calling for us to pay attention to the January indicator. The first 5 days of the year, often investors say that's the way the rest of the year will go. Not a great start, but it's just a start to the year. We'll see how things play out. The first data, as you said, key data, job market data for December, and the manufacturing and the service ISM. The way I see it is that the job market is absolutely solid. Another month of more than 216,000 jobs created on the establishment survey. And we still see strong wage growth, more than 4% sequentially and year on year. And another interesting thing is that not only did the unemployment rate stay at 3.7%, among the lowest in many, many decades, we saw something interesting where it looks like nearly 700,000 people who recently entered the labor market decided for whatever reason to exit it. So the participation rate is 62.5%, well above the lows during the pandemic, but still below the 63% level before the pandemic. It's a full employment economy. We're still creating jobs, mostly on the service side of the economy. Manufacturing is still weak, but it's definitely a full employment economy with no slack, in my view.
Does that give the Fed permission to cut anytime soon? And we came out of last year with a lot of momentum, basically with anticipated cuts, perhaps even early in the new year. Given those jobs numbers and the numbers we're getting right now, does it give the Fed any permission to cut at this point?
Not yet. I think the disinflation that we've seen during 2023, and it more needs to occur in 2024, has opened the door to cuts beginning in 2024. We think the first one will be in June and should be no earlier than June. And it would just be so odd. There's no historical precedent since 1960 of the Fed cutting when unemployment's below 4%. The stock market is basically at all-time highs. There's no reason for them to rush it. And the more the markets try to rush the Fed to cut, the more I think the Fed should make markets wait.
The numbers we're getting indicate that the fourth quarter was probably stronger in growth than a lot of people were anticipated, as a practical matter. What is driving this economy at this point? Because it is stronger than most people anticipated, stronger than most of the rest of the world at this point.
Well, the fourth quarter, still yet to fully be reported, is slower than the third quarter. And we expect the first quarter of this year to be even slower. So there is a clear slowdown in the job creation, on the services side, on the consumption side. There is a slowdown, but less slowing than anybody would have thought, including us. Consumption stays strong. Lifestyle is sticky. People have a powerful, we talk about pent-up savings, but the wealth effect that has come from the stock market, and maybe a little bit of confidence that by the spring, the housing market starts to recover in terms of activity. People feel really good about their balance sheets, and they have their jobs.
Is that explaining what's going on with the consumer? Because the consumer is really supporting this economy rather dramatically, and much more, as I say, than we expected. We thought, as you said, that people would have spent down that excess savings that they accumulated before.
Well, the stock market's helped them out. A little bit of relief on the longest term treasury yields and mortgage rates, but still pretty high. Consumers don't want to change their behavior, especially during the holidays, when they don't have any hit to their balance sheet or jobs. But I think this new year and the first half of this year, particularly before the elections, I think it's going to be a more cautious environment, if not by households, by businesses in terms of their hiring, their inventories. I think there'll be more inventory liquidation, and I think they'll be cautious on their capital expenditures.
One of the things we saw in this first week of the new year was some of the Magnificent Seven, the Big Eight or whatever you want to call them, really fell off a bit. Apple certainly took a hit. Tesla took a hit at some extent. Some people are already saying, has it changed from what we saw last year? Is it too soon to tell?
Well, again, that kind of relates to that January indicator. The first several days of the year, it looks like investors are saying that their risk appetite is not that robust given these valuations and what the market did last year. And you see a bit of a preference, a distinct one, of investors looking for value and trying to get away from mega cap tech. These are great companies, but the valuations are extremely demanding. And I think one of the things you'll hear from many companies during earnings season that begins next week is things are good, not falling apart, no recession, but hold your horses. It's going to take us time to deliver the strong earnings growth that you're expecting from AI and other things.
Well, just a question about earnings growth. I mean, because last year was okay, not as bad as people anticipated. Some people thought it would be an earnings recession. Where are we positioned right now for earnings?
Well, the earnings were flat at the S&P during 2022 and 2023. Really peaked out about $55 late 2021. And just finally started getting above the mid-50s in the third quarter this last year, and I expect that about $58 in the fourth quarter of 2023 to be reported in the coming weeks. We're exiting the profit recession, but most of the earnings growth is coming from tech and digital businesses, the mega cap tech and digital businesses. I expect those businesses to do, and they better do, they're priced for it, over 20% earnings growth this year and in 2025. I think some companies will say that might be a bit of a reach for them to deliver, particularly in the first half of this year. And for the other non-tech companies, it's a slow global economy. It's still sluggish in manufacturing, still uncertainty about interest rates, geopolitical uncertainty, election uncertainty. I think earnings outside of the big cap tech names will still be flattish to low single-digit growth through the first half of this year.